This is the Times Television Network, and you're watching ET Now.
Let's get in then. Ross Norman, he's Chief Executive Officer, Sharps Lipixel, and he joins us on the show. Ross, hi. The gold is firmer this day and rising prices are curbing the Asian demand there. What's your sense on the prices at this point in time?
Yeah, well, of course, this is the season for good physical buying across Asia, not only in India at the moment with the wedding season buying that we're having at the moment, but also indeed in China. And this month sees the Year of the Horse starting, which is a very auspicious time for gold buying as well. But broadly speaking, Asian demand remains very, very positive. Premiums in China are currently running at $20 over London. But of course in India it's a very different story, where with the government raising taxes on the import of gold from 2 to 10%, added to which you've got local import duties and indeed a higher premium because of the scarcity of gold, consumers there are paying up to 20% premium on their gold. That's nearly $240 an ounce premium for their gold. So notwithstanding those high prices, in local terms, gold buying remains pretty good actually.
Ross, also the gold prices have gained, as we just pointed out, nearly 4% in last 6 trading sessions in 2014. Do you see that as a result of fund allocation, or would you say that the demand perhaps has returned?
I think what we're seeing really is the short positions on COMEX, on the New York Futures Exchange, are running at near record highs. If they're effectively discounting the entire economic crisis. We're back to levels not seen since pre-Lehman days. So what we're seeing, I think, in effect, is some short covering on behalf of some of those people who are running a very large short position. In other words, they're saying to us, okay, the economy may well improve, but we're not entirely sure. So there's a bit of buying going on, and I suspect it's related to that market there.
Ross, what is your view on the gold prices then in the short term as well as the long term? Do you see this continuous strength go on further now?
Yeah, it really is a story of two halves like that. In the short term, I think many analysts all agree that gold will come under further pressure. I think people want to see the bottom ground out of this market, perhaps dipping to 1180. We've seen that recently, end of last year, perhaps even lower than that. And of course we're now eating into the real cost of producing gold. So in the short term I think we're looking for a little bit of a price weakness. But with the markets almost universally bearish, for us contrarians out there it's actually quite a good sign. I think in the longer term, looking at the second half of this year, I think we can start to see some really good price strength. We expect gold to be firmer on the year by a small few percentage points. And for gold that's a bit of a rarity. It normally sees galloping multi-digit rises or falls. It knows no middle ground. This year we think will be a bit of a Goldilocks year, not too hot and not too cold.
Let's talk about India then, Ross. And do you see Indian government further easing the gold import policies, or would the elections hamper the process, as we really are waiting for these policies to be eased as we head into the new year?
Well, I think they'd like to. I mean, gold is very much within the DNA of the Indian population, and it's the major medium through which one buys and sells and has a store of value. And of course this massive incremental increase during the course of last year, coupled with which there are a number of rules and laws which have thrown a bit of a fog over the whole gold procurement process for importers, has made it very, very difficult for official institutions to import gold. The only other alternative, of course, is smuggling, and we understand that smuggling is extremely rife. So I think the government would like to be able to reduce those import tariffs, but of course they've got a very significant current account deficit problem to account for. So I suspect that the answer will depend upon whether we see some firmness in the Indian rupee. Of course it fell about 10% during the course of last year. If it stabilises, perhaps there may be some scope to loosen up, lighten up perhaps on those import duties, which I think will be very, very popular politically speaking.
Ross, as you mentioned that the gold prices can decline up to 1180 on the lower side as well, but at what level will it become unfeasible for the miners to produce gold then?
Yeah, we're getting to those sort of levels now on a marginal cost basis, which is the cost of producing any given ounce for gold. It's about $950 an ounce, and of course, so that's a couple of $100 below where we are today. But of course, mines have more costs than just the cost of processing their ore. They have infrastructure and warehousing and other costs associated with it, not least of all depreciation of the mine, etc. And the total cost of producing gold is about $1,250 an ounce on an average. Now, of course, gold is below that figure, so what one can see is that many mines will be producing gold at a loss at these current levels on a total cost basis. That cannot be sustained in the long run. Now, going back to my earlier point, I think that gold may well dip in the short run, but it can't sustain these levels in the long term. We feel that we have a little bit of short-term price weakness before longer price strength. And I think also, reflecting that price weakness, we're already starting to see some cutbacks in some high-cost producing countries like South Africa and indeed in West Africa as well.
Final question then, Ross. And what percentage of one's portfolio should be kept in precious metals according to you for 2014?
Yeah, well, they normally say, about 5%. I take the view that gold is very cheap insurance for a possible economic catastrophe. Now, there are some signs of economic growth. Some of us are fairly sceptical of those figures. So, as a contrarian on the economic reports being produced by the US economy, in particular, US Federal Reserve in particular, what chance would you say that there is in 2014 of a repeat episode? Now, if you said 1 in 20, well, there's your allocation. 5% of your portfolio should be in gold, and we think it's about right.
All right, Ross Norman, we hear you. Thank you so much for joining us and giving us your sense on the precious metal space.
This is the Times Television Network, and you're watching ET Now.